Hi, let's continue with financial analysis and reporting session 2. We have already discussed about different types of ratios. The first category of ratio is known as profitability ratios. You know that profitability means the ability of the firm in making profit. There are certain key areas in which the firm can make profit. So the first and most important area is known as the margin. Margin is known as how well the company is fixing the selling price for the products. The second key area is known as how well the firm can control the expenses. Manufacturing expense, administration expense, selling expense, and all other expenses, how the firm can control all these expenditures. That also tells about the profitability of the business. And the third one is how well the firm can make return from the assets. That's also very important to evaluate the profitability of the business. So these are the three key elements of the profitability analysis. Let's look into the different ratios that are used for evaluation purpose. The first one is known as gross profit ratio. There is a formula written there, that's gross profit divided by net sales into 100. That's known as gross profit ratio. So this ratio tells about how well the firm controls all manufacturing expenses, how well the firm fixed the selling price for the products. So these are the two key things given by the gross profit ratios. The firm is charging a selling price appropriately for the products. This GP ratio will definitely be better. If the firm is definitely controlling all manufacturing expenses very efficiently, then GP will be better and gross profit ratio will be better. And the second ratio is known as net profit ratio. The formula is net profit after tax divided by net sales into 100. This ratio tells about how well the firm controls all kind of expenses, manufacturing expense, administration expense, selling expense, and each and every operating expense, how well the firm controlled all expenses to make maximum profit. That ratio is known as net profit ratio. And the third ratio is known as return on assets. This ratio tells from the investor's point of view, if I put this much of amount in the assets, how much return I will get from the asset. That ratio tells about the utilization of assets to generate profit. And the next one is known as return on equity. This is the most important ratio from the shareholder's perspective. If I invest this much of fund in the company, how much return I will get from the shareholder's point of view? This is a big question, and he wants to evaluate that. That ratio is known as return on equity. Look into that formula. Net profit divided by equity into 100. Second category of ratio is known as liquidity ratio. These ratios tells about the working capital management of the business. These ratios tells about the ability of the firm in meeting the short-term obligations. The first and most important ratio is known as current ratio. This ratio tells about how well the firm is managing the liquid assets. Current assets divided by current liability is known as current ratio. The firm should not carry more current assets and should not have downward current assets. It should have adequate current assets or optimum current assets to meet all kind of obligations. That's the peculiarity of current ratio. Working capital is nothing but the difference between current assets and current liabilities. There is one more liquidity ratio which is known as quick ratio. Look into that. Current assets minus inventory minus prepaid expense, all divided by current liabilities minus bank overdraft. This ratio tells about the firm's ability in making the payment or meeting the obligations very quickly within a short span of time. Say for example, one particular supplier of material supplying the material and he wants to get the payment within 7 days. So the company should have enough cash in their hand for meeting their commitments. So that ratio is known as quick ratio. How fastly they can meet their commitments. That ratio is quick ratio. And the next set of ratios are known as asset management ratios or activity ratios. These ratios tells about the efficiency of the firm in using the assets to generate profit level of the business. That's known as asset turnover ratios. So there is a formula for asset turnover, net sales divided by average total assets. And the second ratio is known as inventory turnover ratio. The formula is cost of goods sold divided by average stock. This ratio tells about how well the inventory comes in and goes out of the business, how many times, whether the inventory come and sit in the business over a long period of time, which killing the efficiency of the business or not. You can evaluate that with the help of inventory turnover ratio. And the next one is debtors turnover ratio and average collection period. Average collection period tells about how well the firm can collect the cash from the customers, very fastly or slowly. That ratio is known as average collection period. All these ratios are coming under asset management ratios. Next category is known as financial structure ratios. This ratio tells about the relationship between debt and equity. This ratio tells about how well the firm is financing the assets. That is known as financial structure ratios. There are certain companies using huge amount of debt and less amount of equity in the financial structure to manage the business. These companies are taking higher risk because they have certain commitments to meet the payment of interest as well as principal amount over a long period of time. So this ratio tells about the riskiness taken by the firm. So what's the formula for that? Debt divided by equity. There is one more ratio tells about the financial structure, that's known as debt to total asset ratio. Debt divided by total asset into 100. And the next one is equity ratio. Equity divided by total asset into 100. The most important ratio that used by banks and financial institutions for providing the loans to the companies, that is known as interest coverage ratio or times interest earned ratio. Let's look into the formula earnings before interest and tax divided by interest, that's known as interest coverage ratio. This ratio tells about how well the efficient the firm is in meeting the interest payments. So that ratio is known as interest coverage ratio. And the last set of ratios are known as market test ratios. These are the most relevant ratios used by the equity shareholders for the investment purpose. One of the most important ratios is known as price earnings ratio. Market price divided by EPS, that's known as price earnings ratio. And another ratio is known as earnings per share, net profit after tax divided by number of shares. What is the earnings available to the shareholder on one share? That's given by EPS. And second ratio is known as dividend per share. Dividend per share tells about how much dividend you will get from one share of that company. So the formula is dividend divided by number of shares. Especially the old investors are investing their money in some companies with the expectation of getting dividends. They always look into these ratios, dividend per share. And the next one is known as dividend payout ratio. This ratio tells about how much proportion of profit will be given as dividend to the shareholders. Certain companies are paying the entire profit as dividend to the shareholders. Some companies are paying only 10% of their profit as dividend to the shareholders. Depends on their needs and wants. So dividend payout ratio, look into that formula, DPS divided by EPS into 100. And the last one is price earnings ratio. This is the key ratio that used by shareholders for the investment into the equity shares. That ratio is known as market price per share divided by EPS. All these are the relevant market-based ratios. So I think you understood the category of ratios. Okay, thank you.